This video covers Chapter 19, which is about mastering your emotions. Basically, over about the last 20 or 30 years, researchers in finance have discovered that investing was not always a rational event with many people. Rather than just being driven by pure reason, a lot of people let their emotions drive their investing decisions. And that's led to an incredibly interesting field of study called behavioral finance. And that's essentially what Chapter 19 covers in a nutshell. So I'm going to talk about maybe 10 or so different behavioral issues that we see people exhibit as it relates to investing. The first is that people only seem to focus on about the last month of stock returns. So when they're evaluating, when they're talking about how the stock market did, they only talk about the past month. But one thing I have tried to do in 216 is discuss long-term stock market and bond market returns and risk. And one really big important aspect of that is that the stock market is volatile. It's far more volatile than the bond market. It's also hard for me to talk and type at the same time. I don't know if I'm going to do a very good job of that. So it's far more volatile than the bond market. Both the stock and the bond market have ups and downs. It's just that the downs in the stock market are usually far greater than the downs in the bond market, and the upswings in the stock market are usually far greater than the upswings in the bond market. So it is just incredibly important that you realize the stock market is volatile. Over here I have just a graph of this is the Vanguard Total Stock Market Index Investors Fund. So it contains about 4,000 stocks in it. They're generally based in the United States. The bulk of them are. So it's not a world stock market indicator. It's just basically a U.S. stock market indicator. But you can see that it is volatile. Like if I'd invested in it in May of 92 and held it to this peak, I would have earned basically a holding period return of 239%. But you can see that the market crashed in the early 2000s. And so from here to here, it fell quite a bit. And that would have resulted if I'd held it from, again, this time period through this time period. I'm trying to get to the bottom of that drop. Gosh, my return would have been far less. It would have been only 84%. When I move my cursor, it's going to shift the number, but what I'm looking at is this percentage change right here, which is changing as I move my cursor. And so what happens is many people are driven by another two emotions, greed and fear. Right here, they see their friends who were invested in the stock market doing really well. There was a nice upswing for this 5-year time period. And so they'll buy into the stock market here when the market is peaking. Well, buying when the market is high is probably the worst time to buy into the stock market. You want to buy into the stock market when it's low. That doesn't mean you shouldn't be buying into the stock market when it's doing well, but you shouldn't suddenly shift all your money to the stock market when it's doing really well and then get out of it when it's doing poorly. And that's exactly what some people do. So they'll buy into it here, and then the market experiences a huge drop. They get scared, and they immediately take all their money out of the stock market. They let it recover, and they see it's now doing well again, so they go, oh man, it was a mistake for me to take all my money out of the stock market. I should have kept it in there. And so they'll put all their money back into the stock market, and then there's another drop, or bear market. A bear market's when it drops. And so it drops, they'll get out of it right at the bottom again because they've gotten scared. That is the worst possible strategy you could possibly follow. In 2008, and 2007, when the market was doing really poorly, we saw exactly that. I think I mentioned in class a couple of days ago that we can track the total amount of money that's put into mutual funds and taken out of mutual funds. And we saw billions and billions and billions of dollars withdrawn from equity mutual funds when the market crashed here. And so what those people missed out on was this subsequent huge upswing that we've had in the stock market since 2000, since February of 2009. So the market has recovered from the huge crash that we had from the financial crisis, and it not only did it recover and get back to here, it's gone far above where it was when the before the market crashed. So over here we'll put greed and fear result in people getting out of the market when the market is low. I'll say when the market, I'll go ahead and put as low, and buying into the market when it is high. And again, those are the worst two possible times to sell and buy. So I'm just trying to get you to look at the market on a long-term basis, not months, but decades, just to realize that there's a lot of volatility in the stock market. There will be upswings, there will be downswings, but on the whole, the stock market tends to go up. And you know what I'm going to do? And hopefully, oops, that's not what I wanted to click at all. What I'm going to do is track the overall stock market for a longer time period. This, I don't think y'all can see what I'm typing in, but what I just inputted was the ticker symbol for the Standard & Poor's 500, and it should give me a multi-decade, there we go, that's what I want to show, indicator of the stock market. So if we had bought into the S&P 500 on January the 1st of 1950, you can see the huge, huge rise that it's had since then. Your money would have grown by 12,127%. Obviously, that's not a year, that's the total holding period return. But when I say the stock market tends to rise over the long run, this graph shows that. And yes, it has, I guess I'll call them hiccups, although that's probably more than just a hiccup. It has swings. It has huge swings. But if you stay in the stock market for the long run, you're probably going to do just fine. That's why you should know the long run history of the stock market. And not just the stock market, the bond market as well. Other things that we see occurring relate to ego and overconfidence. Extroverts tend to make more trades than introverts do. The more trades you make, the more costs you have, and the lower your returns will be once you reduce those returns by your cost. I can't type and talk at the same time. People who are overconfident tend to make more trades as well. One thing that we see is that men tend to be more overconfident than women are, and so men tend to make more trades, and that results in lower returns for men. Now, this is very broadly speaking. There's a guy who's done a whole lot of research on gender and investment decisions, and he studied like 60,000 different investors. So he's looked at a huge group, and these results are from his work. Interestingly enough, this is another thing I found interesting. Mensa is the organization for people who have high IQs, and so you'd expect the people who are in Mensa to be really smart and maybe earn a higher return on their investments. Well, they actually have an investment club for Mensa members, and interestingly enough, they underperformed the total overall stock market by 12% a year over a fairly lengthy time period, although I don't remember the length of the time period. So just because you're smart doesn't mean you're going to make good investment choices. In fact, that overconfidence may lead you again to make more trading and make poor investment choices. People also seem to be very averse to losing money. And that's certainly understandable, but they're so risk averse means they're not willing to take on more risk unless they expect to get a very nice reward in terms of return for doing so. But some people are so risk averse that they won't invest in stocks at all, and instead they might put their money in their savings account or a certificate of deposit, which right now is paying a 0.5% or 1%, maybe a little over 1%. So basically, those types of investments are losing purchasing power. For money that you're trying to save for retirement, that's a very poor investment choice. So being too risk averse can lead to your investing only in low risk securities like CDs, certificates of deposits, or a savings account. Which do not even keep up with inflation. So you're losing purchasing power. So don't be that risk averse. It's very difficult to try to convince somebody who is that risk averse to shift their investments, but basically what I do is just show them the return that the stock market has generated, show them how much money they could have after a fairly lengthy time period if they put their money in the stock market versus what they would have if they only invested in their savings account or certificates of deposit, and show them how much purchasing power they're losing, show them what they're going to need to live off of in 30 years if inflation is 3%. We've tested people by just asking them questions. How much money are you willing to lose for the potential of earning X dollars in gains? And it turns out that people are willing to invest in the stock market so long as they don't lose more than about 12%. So the maximum loss that people tend to be comfortable with is about 12%. Again, that's a loss. Unfortunately, there are times when the stock market loses more than 12%. 2008 was a good year, and to represent that, I mean, it wasn't a good year. 2008, we lost about 36% in the U.S. stock market. So that was enough. That loss was so huge. We hadn't seen losses that big since the stock market crashed in 1933. So it had been years and years and years since we'd seen a loss that huge. But unfortunately, that loss was far more than 12%, and that caused so many people to take all their money out of the stock market. And in some cases, they still haven't put it back in. Essentially, we feel the pain of a loss more than the pleasure from a gain. And that keeps us from investing in the stock market. Some people avoid the stock market because of that. And again, hopefully in 216, I'm just trying to point out that the market is volatile. There will be years when you lose money, but if you keep your money in there over the long run, you're probably going to do quite well. The fifth issue, I don't know if we should call this an emotion, but it's a behavioral issue, which is really what chapter 19 is about, is paralysis by analysis. Studies have shown that when people are faced with too many choices, they just sort of freeze and they don't do anything because they are overwhelmed and they don't know what to do. There are thousands of mutual funds to choose from. That's one reason I, for your Learn by Doing, asked you to limit yourself only to Vanguard index funds because I knew there were thousands of mutual funds out there, and how in the world are you supposed to narrow them down? So I narrowed them down for you and said you could only choose Vanguard index funds. And not only that, there's also thousands of exchange traded funds, ETFs. These are ETFs didn't even exist before the early 1990s. So people today who are investing are faced with far more choices than people 30 years ago. And it's just difficult to make the decision. And so what many people do, rather than having to decide which of these thousands of choices should I make, they simply don't do anything. This isn't necessarily the reason for what I'm about to say, but I was just reading an article this morning that said that 1/3 of the people that are aged 50 to 65, so people who are, you know, very close to retirement, have no retirement savings whatsoever. I was saddened by that. Another issue is called the endowment effect. And that's the idea that things that you're familiar with are considered safe. Although in reality, that's not true at all. One a good example of that is Enron. Enron is a company that many people worked for. They put all of their money into shares of Enron, which eventually went bankrupt. And I can't remember how long ago that's been, but it's probably in the 1990s. And so they worked for Enron. They had all of their 401k funds invested in shares of Enron. Enron went bankrupt. They lost their jobs and they lost all of their 401k. So, again, I'm trying to get at the idea that you need to diversify. Diversify across industries, diversify across countries, diversify across different size companies, so large caps versus small caps, diversify across stocks and bonds, although not necessarily bonds if you're really young. Don't focus all of your money in familiar things that are safe. I'll even yell that by capitalizing it. There's also mental accounting or the house money effect. That gets at the idea that money that you receive that you hadn't planned on getting. So if you get maybe a bonus at work, or um, gosh, if your parents gave you some money you weren't planning on them giving you for graduation, perhaps, or if you win money while you're gambling. So money that you just didn't earn through, the sweat of your brow. People tend to spend that type of money much differently than they would spend their regular income. For instance, they will take a lot more risk with that money. I'm trying to think of how to phrase that. So they'll take extreme risks with that money. But what you've got to realize is as soon as that money becomes yours, it's yours. You should invest it as you would normally invest your money. Don't take more risks with it. And I want to admit, I've probably been guilty of at least half of these, maybe even more than half. Some of them, even though I realize I'm doing it, it's difficult to overcome them. And it's just taking a lot of, gosh, I don't know what, I guess maturity maybe, to get past some of these issues. Anchoring is something else we see a lot of people do. So let's say in 2003, I bought a house for, I don't know, $400,000. Then the real estate market crashed, and by 2008, the house is now worth only $300,000 in the market. And for whatever reason, I need to sell. It is very difficult for people to be willing to list their house for less than they paid for it. They anchor their mind to a certain number. They don't want to get less than 400,000 for that house, even though they can't sell it because other houses are selling for a lot less since the real estate market has crashed. Real estate agents say that's one of the most difficult things for them to address with their client is getting them to list the house for a price that's a fair market value. Instead, what clients do is they look at what they paid for the house and they set the selling price based on what they paid for it, not what comparable houses are selling for right now. People do the exact same thing with stocks. So let's say I bought 100 shares of Apple for, I don't know, $140 per share. And right now, the current stock price of Apple is $125 a share. I might refuse to sell them because I would have to sell them and lock in a loss. And I might rather wait until I can sell them for at least $140 a share. And that might take months or years before Apple gets back up to that price. But people anchor a certain number in their head and they just refuse to let that number go. Here's something I hope y'all are never guilty of, and that is financial negligence. Some very famous people, Nicolas Cage, um, I don't know if he had to file for bankruptcy, but I think he did, or he came very close to having to file for bankruptcy. Burt Reynolds, hopefully y'all know who that is having to sell off a lot of his assets to be able to make payments on money that he used to buy a house. He took out a loan and he's not generating enough income to be able to pay off that loan, so he's having to sell a lot of things. Michael Jackson, even though he had millions and millions and millions of dollars, it was just managed so poorly that at one point he was having difficulty maintaining his house. Many, many lottery winners find themselves right back financially where they were before they won the money in the lottery. So please don't be guilty of financial negligence. Make sure that you just learn the basics. So, what can you do to keep your emotions in check? Basically, you need to set some realistic goals and a time frame. Make plans. There's a word I'm trying to think of, and I cannot think of it. Self-control is not the word I'm looking for. But just basically stick with that plan. Say, okay, every month I'm going to deposit $100 into this account. It doesn't matter if the stock market has just crashed or if the stock market's super high. I'm just going to diligently follow my plan, put in $100 each month. Now you also need to understand that you'll be making revisions to your plan, you'll have to choose an asset allocation, and that asset allocation shouldn't stay the same over your whole life. My asset allocation is a lot different now when I'm nearly 50 than it was when I was 30. So remember to revise those plans as needed. But that doesn't mean, sell out of the stock market once it's crashed or buy into the stock market after it's risen 20%. So that this actually relates to number two, but periodically review your investments and rebalance as needed. So when you're making these plans and doing your rebalancing and evaluating your situation, always look at the long run as well as the short run. So keep in mind again that the stock market's really volatile, but over the long run it does really well. Keep in mind the relationship between short-term investments. Sorry, that's not what I meant. Small cap investments versus large cap, foreign versus domestic, the diversification that offers you, the correlation benefits you get from diversifying like that. Don't focus too much on a specific category of investments. All right, that's it.